Welcome back to Bold TV. I'm David Grasso. Today, we're going to talk about entrepreneurship and startup funding with the CEO and founder of Nobody Studios, Mark McNally. Hey, Mark, let's get right into it. What if you have a good idea? Why is it so hard to raise money these days?
Hey, David. First of all, thanks for having me on. Um, I think the ecosystem's changed. I've been doing startups 25 years, and it used to be you could kind of sit down with an investor and you could show them code and show them how something worked, and they would get into the weeds, and you would have a natural funding path that lets you kind of build your MVP and eventually find the right product and market fit. I don't think what people don't realize is that the amount of capital coming from Wall Street today has completely changed the funding cycles. And so you either have to qualify for being, I'm going to build the next unicorn, or it's not worth people's time to look at it because they're trying to apply so much capital to early stage startups. So you really have to be able to pinch out a company that's going to be a billion or plus, or people are losing interest.
So people don't realize that historically California exists for people running away from New York, right? LA became LA because they didn't want to pay royalties to Thomas Edison, who had the copyright on film. And Silicon Valley became Silicon Valley because the bankers were too conservative, right? But these days, Silicon Valley and Wall Street are very similar. What does that
Yeah.
mean for the startup world?
It's really ironic. I mean, like you said, Silicon Valley created this ecosystem where you could be very creative and very innovative outside of a traditional banking structure. And that's why you have so many great ideas, birthed over the last 20, 30 years. I think fundamentally, when Facebook was the first big startup to sit on sidelines for an extra couple of years, and when they went in public, they went out at like a $60 billion valuation. And Wall Street was like, wait a second, we're used to making our big pops on the IPO, and it didn't happen this time. And then Uber, and then everybody else started doing that same thing. And ultimately, Wall Street had no option but to chase the returns it had gotten addicted to over the last 20 or 30 years. They had to chase that back down to Main Street in Silicon Valley. And so the domino effect is you have to put more money into young companies, and in came the traditional Ivy League folks and a little bit less company creators, and it's just kind of started to change the culture.
Yeah. So, but what does that mean for America, right? And we've seen so many funny stories. Like my staff will put up the Juicero machine. You can play that video now. Staff.
Funny enough, our next headline is probably my favorite. So, a few weeks ago, the company Juicero became the laughingstock of the internet when a couple of Bloomberg reporters figured out that manually squeezing the company's juice packets was just as effective and even slightly faster than using the brand's fancy $400 juice machine.
In fact, that company got, millions and millions of dollars from Google and from other big names. So what's happened is that startup funding doesn't make any sense anymore. And everyone realizes that. And in fact, it's actually reverse engineered because startup founders create companies that are likely to get funded and not actually create real products. So now
That's
that
true.
we've established that, what does this mean for America? Is this bad news for our country?
Yeah, I'm not the typical gringo. I'm pretty worldly in my worldview, but if I'm putting on my American hat, I think you're spot on. What the side effect is going to be, the Elon Musks of yesterday or of tomorrow, they don't have to come to Silicon Valley to get the same access to capital. In fact, there's a lot of better places to find it. A lot of the talent that we've been attracting for generations to come here and innovate are going to stay in their home country and do it. The capital's become more democratized. You can raise online. These economies are growing. The sources of wealth and family offices, et cetera, within their home countries are there. And so it's no longer the mecca it used to be to come and be innovative and creative. In fact, you see the biggest tech giants moving lock, stock, and barrel to other parts of the country right now. So yeah, I think if people really play this out, it's going to have a pretty profound effect. I think the ultimate byproduct will be a new generation of VCs that think a lot like they did 20 or 30 years ago, way more aggressive, way more connected to the early stage creation, and democratization of capital, crowdfunding, and direct investments from angel investors will no longer be kind of a a nice to have. I think it'll be the way it's done.
Well, things have to change, Mark. That's just the way of the world, right? And that has to do with what you're doing. So tell us a little bit about Nobody Studios and what you're doing right now.
Cool. Yeah, thanks. So Nobody Studios is a venture studio. Venture studio is essentially a mix of venture capital and incubation. You've seen a wave in the last 10, 20 years of incubators and accelerators. And I think in concept, they were brilliant. I got attracted to a few of them and started to look at them. The problem is You usually take 1 or 2, 3% equity in a company and you give them this mentorship network. If you really play that out, it's really, really hard for someone to justify going all in with their experience, their relationships, their network, giving somebody an hour a quarter, right? And that's what that kind of plays out to be worth. And so there's not enough skin in the game to truly make that mentor network apply themselves. So I think it's been interesting, but I don't think it's nearly, touched or scratched the surface of what it's capable of. VCs, as we all know, the common stat is they expect 1 out of 10 to succeed. But the problem is, if you ask anybody who's been a long-term VC, what have you seen in your portfolio over the years, and what do you wish you could do that you can't? They would say things that we can do as a venture studio. They would say things like, well, maybe I realized 6 months into it, I wasn't a good bet and I want to kill the project. Well, they can't do that as a VC. Maybe they realized they thought it was 5 companies that they invested in, but really should be merged into one. They don't have the power of merge. Maybe they invested in one, but the idea is too big and they should split it into 5. They don't have the power to split. Maybe they really love this guy, but he's in the wrong company. He should go over here. They don't have the power to do that. So, and once you start funding a company at any stage in the VC model, it's kind of like you lit the fuse on your burn rate. They're going to keep finding a way to raise money, and it's still going to go deeper and deeper and deeper into the capital, regardless of whether or not it's really found product or market fit. So in the venture studio market, we get to exercise all that. We get to pause, we get to split, we get to merge, we get to change talent around. It's incumbent upon us to kill projects off that don't cut the muster. And at the end of the day, that's where you minimize all your risk and you maximize returns.
Well, you have a new. You're preaching to the converted here now, because I always thought the venture capital model was flawed. So you're doing God's word, Mark. On that note, thank you so much for joining us. All the best to you and your family out in beautiful California.
Thanks for your time. Thanks, Aaron.
And thank you for watching Bold TV. Be sure to follow us at Bold TV everywhere for more. We'll catch you later.